Ken Hoexter, Bank of America's transportation, air freight and surface transportation and marine shipping analyst. Welcome to the next panel, the container shipping panel. So thank you for taking the time to join us. On the panel today, we've got Dr. Anastasios Aslidis, CFO and Treasurer of Euroseas and EuroDry, Mr. Deambrosio, co-founder of CMAX Capital Management, Mr. Ted, well, I guess next seating over is John Butler, President and CEO of World Shipping Council, and Mr. Ted Petrone, Vice Chairman of Navios Maritime Partners. So I'm going to just do, I'm going to sit down if I can. I'll do a Q&A, kind of go back and forth, fireside chat questions. I'm going to go ahead and let Tassos, if you want to just get started. I'm going to go down the line and just have everybody introduce yourselves and your companies, take 1 or 2 minutes, and then we'll jump into some Q&A.
Thank you, Ken, and thanks again to Capital Link and Nicholas and Olga for organizing another successful event, bringing us all together here. For those of you who don't know Euroseas, we're an owner and operator of feeder and intermediate-sized container ships. To the best of my knowledge, we are the only U.S. capital markets listed company focused on that sector. I think in Norway, MPC is active in the same sector. I'm saying this because, and I hope it will become apparent later in our discussion, there are certain advantages, I believe, to be active in the feeder and intermediate container sector. We are listed for 17 years on Nasdaq, but our presence in shipping dates back 150 years or more to the second half of the 19th century, when our CEOs, Aslidis Peters's family, traced back its involvement in shipping. Over the last 17 years, we tried to serve the best our shareholders. We grew systematically in a risk-adjusted, in a risk-controlled manner. And in the process, we have spun off our dry bulk fleet on a separate company, EuroDry. And we have recently, on the back of the strong earnings for the last 3 years, embarked on a new building program, trying to do our part in making our industry more environmentally friendly. I will close this brief introduction saying that we do pay a dividend, about 6.5% yield, and we do have a stock repurchase program, trying to keep our shareholders properly awarded in the process.
Great. Cal?
Thank you, Ken. Thank you, Nicholas, for inviting us. My name is Deambrosio. I'm Managing Partner at CMAX Capital Management. Unlike my colleagues around me, we're a private equity.
Move the mic just closer.
Private equity firm, opportunistic. Our thesis is pretty straightforward: buy low, sell high. We set up the firm about 10 years ago. We raised about $1 billion in debt and equity and focused in the container shipping space. Our focus has been in the post-Panamax segment. To date, we've made distributions annually about 7% per year. We're now winding down one of our funds, which will come out about 18-20% IR, about 3 times our money. So we're pretty pleased with that. And now we're looking potentially in the next couple of years to re-up and look at similar opportunities. We have offices in Stamford, Connecticut, and we are a technical team based in Leer, Germany. With that, I'll pass it on to John.
John, and Cal, just everybody, you get close to the mic because it's really loud going on in here. Thanks, John.
Sure.
John, over to you.
Thanks, Ken. John Butler, World Shipping Council. Unlike the rest of the folks on the panel, we are a trade association. We represent the liner sector, I think container ships and vehicle carriers. Our membership on the container side represents about 90% of global capacity. We have offices in Washington, D.C., in Singapore, in Brussels, and in London. And we work on the advocacy side at national level, at regional level, for example, in the EU. We also have consultative status at the International Maritime Organization, where we do a lot of work on environment, safety, and other issues. And basically, our members are all operating companies, which makes us a little bit different than some trade associations. And we advocate for policies and regulations that put our members in a position to operate and compete effectively And we also work with our members on industry-wide issues such as decarbonization, safety, and that sort of thing. We have great relationships as well with a lot of the other international associations within the industry and use that as a force multiplier among us. Thanks.
Mr. Ted.
Sure. Ken, thank you. Ken, thank you. John, thank you. Nicholas, wherever you are. So Navios is a publicly traded shipping company. We've been around for 70 years. We were U.S. Steel when I first joined, but I would like to call us a 19-year startup since we went public in 2005. We have 176 vessels, let's say half are dry, a quarter are containers, and a quarter are tankers. Diversified fleet. We believe, remember we were three pure plays. We decided to put under one roof. We thought the risk and rewards were coming quicker and the risk was higher and the rewards were higher. So a diversified fleet, you know, you smooth out your risk profile, you have cross-segment opportunities. You know, for example, we're 90% fixed on containers this year, 80% next year. The circa $3 billion we took in contracted revenue we put into new buildings on the downside of tankers before they started moving up and dry, and we're putting them out on long-term tonnage. We're a time charter player, which lends very easily into the container side. We're a tonnage provider. Usually we're 10,000 in dead TEU, sorry, and less. Basically half of the fleet is baby Panamaxes. We're actually a bit more bullish than we would be on containers. I think we have this order book we're going to talk about, but you know, the world's changing very rapidly, and we think the diversified fleet is the long-term play, certainly for us, and we hope for the shareholders.
Great. So we've got, if you kind of ran through that, we've got some asset owners. We've got an investor and asset owner. We've got regulatory and another asset owner. I'm going to get you guys a little uncomfortable. We'll talk a little bit about the market itself here and there, but let's talk about the asset side. So maybe Tassos or Ted, I'll start with you and the role of capacity owners versus operators, right? So what percent, maybe talk about just general, what percent of the fleet is now owned by capacity providers? How is that shifting the desire in the market over the past decade? Talk about the operators in terms of lessors versus the owners. And did that change as they became flush with cash? Did they go in and start adding to that order book, or is it still the same distribution as percentages? What's your thought on the market?
Clearly, the container ship market is a bit different from the dry bulk and the tanker markets in the sense we're used to, because for us, the vessel owners, we face an intermediate level of demand. There is demand for container as trade in the world, which is primarily served by the liners, and then they convert that to demand for ships owned by independent owners. So there's that middle layer of the liner companies that essentially sort of control the supply-demand for us. So we're a bit removed, and at the same time, it's an oligopoly. We're selling oligopsony, I should say. Few people buy from us. So it's not as competitive, I guess, as the dry bulk and the tanker market. You have to develop strong relationship with the liner companies to be able to get your ships chartered. The plus side is that depending on the size, you can get into longer-term contracts with your clients. That is less frequent on the dry bulk side. So I'm trying to give you some general perspective of the market. The smaller ships, like the ones we own, resemble a little more to the dry bulk and tanker market than the larger ones that require bigger capital expenditures and more commitments from their clients. We are playing in a sector that has not as frequent long-term charters as the bigger ships. The liner companies are focused on owning ships themselves because they want to control their costs, but really are focused on owning the larger vessels. They tend to leave the smaller ships to independent owners like Euroseas and some of the others to provide that. Let me stop here and let other people.
Ted, you want to throw on thoughts?
Well, I think exactly right, Anastasios. We see it as almost a 50-50 split between the liners and the tonnage providers. similar on the, as you're getting more to long-term to shorter-term, 50/50. So it's interesting for us because we came in through the dry side and the tanker side, and the period market was, long-term period market was very attractive to us because you're locking in long-term sustainable cash flow. I think these guys know better than I do, but there was a big change in who had the power and who didn't have it during the pandemic. It's come back now to the buyer side, and so we're watching negotiations play out. We're watching time charter play out. We're watching the tanker rates, the container rates, maybe slip down a little bit from the high it was. I think the market's moving slightly, but I think the period market is interesting because it's like the housing market in the States to me. There's very few houses on the market because no one wants to get rid of their 8%, the 2% mortgage. So if you want to get a ship for period, even though the market's soft, you got to pay the asking price. And I think the same thing is going on in the container industry right now.
So Cal, you talked about the returns that you were able to get, and you're talking about a new fund. How do you have the edge in the capital provision versus the large lessors, Seaspan, Danaos, in terms of competing in that market and getting the returns? What is the specialty that you need to know in the container ship market?
Well, I mean, being a private equity firm, we don't have a legacy situation. We are not a family that needs to keep the family business going. We're not a publicly traded company that needs to have a forward look. Our intention is to go in and out at the right time. And shipping for us was always a very cyclical business that it's very predictable. When the market's low, it's low because there's too much tonnage in the market space. And it takes a while for the tonnage to get absorbed into the trades. And once it does, then, as Tassos mentioned, the balance of power changes from the liner companies to the owners, and you can start dictating terms. So from our perspective, was really where to focus. We like the bigger ships. The bigger ships have a couple of situations around them. They are capable of achieving longer-term charters, which is positive. It allows you to manage your cash flows, your distributions, but you need to have a good relationship with the liner companies. One of the things that we've seen since we started the business was there's been significant consolidation on that side. There used to be, in Japan, there used to be 3, and there's now 1. O&E, they call themselves. And similarly, that's happened in Europe and in other parts. And that particularly impacts the larger ships, which is what these folks use. On the smaller sizes, you have a broader pool of players. But from our perspective, it really, the biggest decision that you can make in shipping is when you buy that asset and being comfortable with. And we bought assets without any charters, and the bottom part of the market had to basically live with OPEX charter rates, and then those are our best investments right now. But everybody philosophically has got a different perspective, and it's not one concept it's right or wrong. The other thing I would say is controlling your costs and controlling your technical aspects of the ships is important. So we have a very good team in Germany that we acquired from one of the lessors that was there that had closed shop, and we knew the folks pretty well. So it allows us to basically keep our cost structure under control and the quality of our ships under control. Over the last couple of years, we've had less than 20, 30 basis points of downtime, commercial downtime and technical downtime.
So let's talk about the market a little bit. Tassos or Cal, how is yard capacity now, right? We've got a 24% order book to fleet ratio. How do you see incremental fleet adds? Do you see it growing from here? Is there anything that the market is missing in terms of pace of whether it's disposals, demolitions, slowing shipping speeds, longer lengths of haul? Maybe just talk about the 24% order book.
Yeah, the industry experienced 3 great years. Surprisingly, during the pandemic, there is enough inefficiencies that were created in the system, and that led to ships being in huge demand, and that created strong earnings for us. That led, opposite to what happened again on the dry bulk and tanker market, to a huge order book, partly driven by the liquidity that owners had, and partly driven by the demand of the liner companies for ships I think the reason the rates went really sky high is that liner companies, to a great extent, got panicked that they will be without ships over the next few years, given the fact that all these inefficiencies were introduced in the system. Nobody knows how the pandemic will develop. So all this environment encouraged, and the order book of container ships from about 10% pre-pandemic reached 30% at some point. Now it's down to 23%, 24% that you mentioned. Clearly, that is posing a huge burden now on the industry to absorb it. That's why the rates dropped from the unsupported pandemic high levels to significantly, about 80% by the fall of last year. We're still, although the market has recovered recently because of the geopolitical events that we can discuss, Suez and Panama, primarily Suez, still we have to face the challenge to absorb that extra capacity. Speeds, at the same time, speeds have gone down, which helped. That is a connection of, in connection also to the environmental regulations that are coming into effect. And the other point that I want to make is that the order book is very different from smaller versus larger ships. That's the point I mentioned in my remarks in the beginning. The order book for feeders and Panamax-sized vessels is about 8.5%, 7.9 to 8.5%, while for the whole fleet is 24%, 25%. The fleet profile also of the smaller fleets is very different. We have a significant percent, I believe more than 20 or 25% of our of the segments of the feeder and intermediate segments are older than 20 years. So the supply growth scenarios for the feeders and intermediate ships are very different from the supply growth scenarios for the medium and larger size. The segment between 12 and 17,000 ships, I guess, it has an order book 55% the last time I checked the numbers. So how that the oversupply of the larger vessels will affect the very tight supply, I believe, of the feeder ships, that dynamic is what will determine, at least for our company and our sizes, what will happen.
Oh, go ahead, Ted, you want to jump
No, the numbers are exactly like I said. You've done that well, but let's also look at the overage. Now you say, okay, containers overage. I think it's 12 or 13% for 20 years, and I think it's almost a third over 15 years. And why would you say 15 years for a container ship that will stop trading? They're probably not going to stop trading, but I have to tell you, if you put 3 ships together, tankers, dry bulk, and containers that are the same size, containers are heavier. They have a bigger engine, so they're more pollutant, so they're going to be more affected by the IMO. They will slow down. They'll have to do more retrofitting. There's a whole bunch of issues that give us, kind of green shoots in this massive order book we have. Erling Ness said many years ago, the Norwegian ship owner, God must be a ship owner because he put supply on one side and demand on the other, and he put an ocean in between. I think now he's maybe a container ship owner because it was coming down, and now you have these unfortunate events in the Middle East that have lifted up rates dramatically. And the volume was actually moving before October 7th. The volume of the containers was moving before that because I kind of watched SCFI, the Shanghai Container Freight Index, as a proxy to the world trade in terms of the container rates. And that was starting to go up. It bottomed in September. It was 1,000 the first week in December, and it was about 2,400 by January. And it's now about 1,880. So we're well above pandemic levels. Now, maybe we drift down to that for a while, but I think it's going to take a while. I think the demand is, the U.S. consumers holding up. I mean, government's spending a lot of money letting us buy products still. Europe also, you see the rates going into Europe, and NWE and the U.S. West Coast is still 2.5 times what they were a few months ago. It's not as dark as people think. It's not good, but it's not the end of the world.
So, John, I'm going to get to you in 1 second on security, but I want to get a market rate question out first on what's going on with the Red Sea. So if we think about the Red Sea impact we've seen from peak disruption impact on rates, or I guess have we seen that peak disruption? Seems like rates have continued to come down pretty aggressively, down another almost $1,000 today to 1,800 on the SCFI. So do we expect additional rate spot volatility from here, given the rate? Is it just resettling in now that ships have removed around the Cape? And maybe with that, Cal, I'll throw it to you to answer, and then where do you think rates are for ships today, from your point of view, for 5, 10, 30,000 TEU ship?
Well, I mean, I think there's two things. There's freight rates, and that's what the liner company charges the cargo owners to move their cargo, and then there's the charter rates, which is what owners like us charge the liner companies. During the fourth quarter, starting in the summer of last year, the market started definitely coming down. Everybody started getting, scared, and it was not a good period. But and that's given the order book size. As we've all mentioned, there's about 24-25% order book to fleet ratio. The bulk of that is in the very large sizes. So that's about 10 plus or minus % this year that's coming into the market. And that's what basically drove people to be a little bit panicked. You had the large liner companies. They had 24,000 TEU ships sitting in dry dock out of the yard slotted for 6+ months, just sitting there waiting for cargo to come. Our ships, which are 8,500 to 10,000 TEU, became feeder ships to feed the larger ships for that trade. Now, with the Red Sea, that adds, basically a week plus on the Far East to Europe trade. That translates into more or less 10% fleet capacity being absorbed by that trade. So basically, the whole order book that was coming in is being absorbed for the time being with the disruption through Suez. We also have Panama. It was mentioned before. We have many of our ships that go Far East to U.S. East Coast through the Panama Canal. They're all going now through the Cape, coming back. So that's, Panama Canal is down to 40% of max capacity, and it doesn't seem to be improving in the short term. Addition to that, you have liner companies that question the alliance's slot sharing agreement. A lot of them want to control their own fleets, so that's forcing them to make decisions. In our particular case, if we looked at, we had 2 ships coming due at the first quarter of this year, 8,500s. We were thinking mid-20s, maybe for a year time charter. We were able to get mid-30s for 2 years time charter. So that's the impact on us that we saw as a result of the blockage of the Suez Canal. And we don't believe that this will be a perennial thing, but we don't think it's going to be something that gets resolved in the next 6 plus or minus months. We think that will be there for a while. As owners, we only have period to work with and when your vessel comes due. If you don't have a vessel coming due at the right time, you can't take advantage of the higher rates or the lower rates. So that's something that we're more takers of what the liner companies do. But when we talk about yard capacity, there's two. You can look at yard capacity in 2 ways, or at least we do. There's the larger ships, let's say 15,000, 10,000 or above. And if you order a ship today in Korea, China, you're not going to get anything until 27, 28. But if you order a feeder in a smaller yard, you can probably get that vessel delivered in 2026. So I think they're pretty much maxed out. In addition to that, you have new building prices. New building for a 24,000 TEU ship in 2020, you can get that ship with dual fuel for $150 million. CMA just ordered a group of them for $250 million. So new building prices are not cheap right now. Plus the unknowing factor of what is going to be the fuel of choice, because LNG is not a carbon neutral fuel. It is a carbon emitting fuel. So I think that will keep the order book at bay, but there is very little capacity available for the time being.
So, John, I want to follow that, given the Red Sea disruption. Thoughts from a security, from a policy standpoint, policy issues at the IMO. How do you handle this as a regulatory thought process in terms of protecting seafarers, the whole disruption in the Red Sea? What's your thoughts from an IMO perspective?
Yeah, in terms of the Red Sea and how the regulatory structure fits with that, it really doesn't. This is something that's completely different. You've got a non-state actor with very sophisticated military hardware shooting at and just recently killing seafarers. And so this is not business as usual for us, for the industry, really for anybody. And, you know, this, while the IMO Secretary General has been very vocal and very active in diplomatic efforts, this is really a UN Security Council level situation. And so, you know, you've got a couple of things going on, one being what diplomatic, you know, forces can you bring to bear? But you've got, as I said before, you've got a non-state actor, okay, affiliated with a state, of course, but you know, just in recent days, the Houthi have been sending out communications to countries acting as though they are the government of Yemen, and so this thing has become quite bizarre. I think the other thing that, you know, we'll see how this plays out, but the story that the Houthi have been projecting is, well, this is all about Gaza, right? I've talked to a lot of people that don't believe that, you know, that once this group has taken center stage, as it were, and has created all of this attention for itself, it probably is a little bit naive to think that, you know, who knows what happens, right, with the Gaza situation. But even if that gets sorted in the near term, that's not a guarantee that everything goes back to normal in the Red Sea.
Something I get asked about from investors is, do you see any of the vessel owners or service providers paying the Houthis for transit capability through the Red Sea? Is that something?
I'm not. I mean, if you hear rumors, but I'm not aware of anybody doing that, and
Okay.
there certainly is nobody in the mainstream industry that's doing that.
Certainly something we get asked about a bunch, actually. Tassos, let me come to you on the European contract rates, the process. I know this is, you guys are asset owners, but the process of contracting seemed to be suspended during the Red Sea attacks. We're coming up to the U.S. rate negotiating season. How are things settling? Maybe it's a step removed because you're the asset provider, not the liner carrier. But what are you hearing anything in terms of the progress of the U.S. contracting season?
It's a step removed, and I am not well versed in addressing that issue. So perhaps
Anybody on the dais?
I think, yeah, again, we're a step removed, but I think what we're hearing is some of these the line of services are doing cost plus again. They're going back to volume over pricing. Remember, there was a real disruption in relationships during the pandemic, and some of the suppliers of the goods were gouged. So there was a rupture in relationships, and we're looking at some very difficult negotiation. I'm actually hearing whispers of almost kind of index type of stuff coming in. I mean, it seemed the world's changing,
yeah.
And it looks like to us that you know, it'll smooth out. I mean, it's, you know, they had a listen. Like all the shipping, containers didn't make money for a decade, and then they made 2 decades worth of money. We did in 2 years. Yeah. But that's shipping. You have to cover your downside, and then when the good ships come, you play your upside. I just want to say one thing about the Red Sea, because you know, we have did I mention we have a diversified fleet? We have a diversified fleet, so we have a lot of ships going through. It looks like to us almost 30% of all containers go through the Red Sea, and 20% of all ships, meaning the bigger ships, are going through. The first week in December was before everything started with the Houthis. You had 116 container vessels of, I think it was 12,000 TEU or higher going through. Last week it was 24. So it's down dramatically. We're not going through, and no matter what type of ship we have through there. And I agree with John on the Houthis. These are drug-induced, you know, they're just not good people. And I think it's difficult because we, as you know, the country, we can go in there and take them out, but then you know, we all know who is controlling what's going on in the East, and it's not the Houthis, not the Hezbollah, it's not Hamas. So it's a difficult situation, and there's a loss of life, which is terrible. And for all of us, you know, we wish it'd be over, even though if it does bring somewhat lower rates.
Let me get one more market, and I know, again, it's step removed from your asset ownership versus the market, but can anybody talk any thoughts on where the labor contract talks are going on the U.S. East Coast? versus, the potential for a strike as we get into September, October. I guess just, are your carriers talking about maybe repositioning vessels ahead of that? Is it still too early? Is there talks that you're hearing about from your point of view in terms of what they may do with the vessels in that case? Is there anything, or is that too far removed from being just the asset owner, not the provider?
I haven't heard nothing, but my guess is in an election year, the labor unions are not going to strike.
Election year.
In an election year, the labor unions are not going to strike.
Okay.
My guess.
John, let me come back to you. Cal mentioned before about the state of, alternative fuel technology. We heard about that a lot earlier from a couple of the panels. Clearly a contentious maybe point with a mismatch of expectations from policymakers versus timing of when the fleet. What are your thoughts from a policy perspective in terms of fleet adoption and next stage of decarbonization?
Yeah, I guess to sort of set the parameters of that, and it was said this morning a couple of times, there are really three things we need: fuels, and fuels, right? And so the situation that we're facing now is that while certainly, if you look at some of the fuels, there's a ways to go technologically, but we're much further along. And the real question, and what we hear from our members, at a board level is, look, we need to have a regulatory structure that allows us to make investment decisions. And what that really means is we have to close the gap between fossil fuels and, frankly, whatever the green fuels of the future are. So we are fuel agnostic on that, but there are enough technologies and enough fuels out there that could be employed that this is technologically possible. So there are kind of two things going on at once. One is this massive price differential between fossil fuel and the green fuels. And so without a regulatory intervention, the market is not going to drive us to where we need to be on decarbonization. And so at the International Maritime Organization, which is the only body that has global jurisdiction and where we really need to have this happen, the question is, can you get two parts that work together to close that gap? And the first is to set a greenhouse gas intensity standard to say over time the intensity has to ratchet down. And then the second piece is the economic piece, which somehow has to close that gap between fossil fuels and the new fuels. And for example, we put into the discussion for MEPC 81 a proposal that we call the green balance mechanism, that would be a pricing mechanism that targets collecting enough money from those using fossil fuels to even that out in any given year for those using really advanced low GHG fuels. Because we don't see, first of all, any other way to jump to those fuels unless you have that intervention, and I think most people agree with that. But what we've tried to do is essentially do a rifle shot, so you're not collecting too much money, but you are collecting enough money. The second thing I alluded to about the dynamic is really that in some ways the industry is in front of the regulators. Not only us, but other organizations, trade organizations, have put proposals on the table for pricing of greenhouse gases that a lot of governments around the table are saying, well, that's too expensive. We're willing to do this if it doesn't cost too much. But if you set a price too low, you don't change any behavior, but you just increase the price of the service. So that's a poor deal, and that's the trap we're trying to stay out of.
Can I add a point here?
Absolutely not. Yeah, go ahead.
No, I think it's a big topic, and we can talk forever about it, but it's clearly a cost that society and all of us as consumers will need eventually to bear, right? It's not any single industry that has to complete the decarbonization. So while these regulatory discussions are taking place and the mechanisms for changing behavior are put, we can change our behavior and take steps every day to do whatever we can, given the existing set of tools that we have. You can, if you build ships, you can build the most efficient ships that are currently available. You can do retrofits to reduce the effect on the environment of the existing ships. All these are investments that are economically driven. I mean, we had a ship that we retrofitted, and we paid the cost in conjunction with the charterer. We both benefited, and we made our little bit towards helping the environment. Our new building program, the same. But across the board, I think we're taking economically based decisions to move towards a better environment, but it's a cost at the end that has to be borne by each one of us as a consumers. It's not that ship owners or airlines would have to bear the cost. All of us will pay. So that should be in the mind of the regulators.
Which is very inflationary.
We've got about, what's that?
Which is very inflationary.
Yeah. We've got about four minutes left. I got a couple more left I want to try and get through. Cal, you mentioned before kind of the larger vessels, huge order book. You could get one on the smaller size a little bit faster. Are we entering a new phase of larger vessels ordering now that I'm going to talk about alliances in a minute, but reshaping of alliances, do you see the need? You're going to see larger carriers coming in ordering larger vessels, or do you think a reacceleration on the smaller end given the tighter order book?
Well, I think the liner companies, to a large degree, have already ordered what they foresee will be needed over the next years or so. So I don't see a big jump in order book for larger containers.
So you don't see Maersk coming in and saying, you know what, we've got to re-expand our large vessel capacity?
I think Maersk is trying to focus on get their client back, and they're focused on the inland, much more than on the sea side of the equation. There'll be laggards that will step up, but orders like we saw in the last couple of years are probably not going to happen at that level. They will again,
Okay.
but I don't see that happening in the foreseeable future. On the smaller sizes, I don't play in that market. I'm not really sure, but there's clearly an age issue going on there. And there's also a size issue. I mean, if anything happens in this industry, the ships keep on getting bigger. I remember when we started, the Panamax was the workhorse asset. That's, 40, 250, 5,000 TEU ships. We are the workhorse asset now for most trades at 10,000, and that's getting pushed up to 15,000. We may see some rebalancing of the orders into those segments.
Yeah.
But, from the larger sizes, I'm not that worried about it.
All right.
And for the
Go
smaller
ahead, Tassos.
sizes, because the smaller owners of the smaller ships are smaller in general, and they build their ships based on economic decisions and looking at their own return, the uncertainty that exists about the fuel of the future keeps the number of ordering in check. The same thing happens to the dry bulk in the tanker market. It's reflected on the smaller container ships.
Yeah. Thoughts on the alliances? You've got customers that are now seeing their kind of organizations reshape themselves. Any thoughts on how this gets affected in terms of your ability to place the ships, or from a regulatory viewpoint? Obviously, they're constantly looking at the alliances themselves. John, you want to start off?
Yeah, I won't speak to the commercial side. I have to talk to our members about that. But on the regulatory side, one thing that we have to constantly remind regulators of, and whatever form the regulation takes, is that vessels sharing agreements, even with all the alliances, or some of the alliance activity shifting, the ability to share ships is a critical way that the industry achieves efficiencies, and some of the others have spoken about the efficiencies of individual ships, and that's a critical point in terms of decarbonization. But it's also, it's very important to keep in mind the efficiency of the networks themselves, right? Because sharing vessels has proven to be, in one way or another, the most efficient way to allocate those vessels to different trade lanes. And so it's just really important that we maintain a regulatory posture that allows that.
Anything from the panelists? Otherwise, I'll ask my last question with 0 seconds left. Your thoughts on global trade growth for 24, 25? Any general thoughts?
I think as we seem to have dealt with the battle with inflation, and hopefully we have put that into control. I think we're looking optimistically about the economic growth for the next couple of years. IMF does the same. It has recently upgraded their outlook. So that would be good for the container ship trade demand, I would say.
Yeah,
3% plus, hopefully.
3% plus. All right, Cal?
I think when I started, container shipping was a multiple of GDP. Today is at GDP or less than GDP.
Yeah.
So I would go with GDP as being an indicator of what the trade would.
John, I presume you're not going to, you want to jump, I like
Yeah,
it, jump in with the number.
Crystal ball broken, thanks.
What's that? Crystal ball?
Crystal ball is broken.
Broken. Ted?
Well, in shipping, whether it's natural resources or finished products, China's the 800-pound gorilla. They seem to be importing more and exporting more finished products. Looks to me they're trying to export somewhat out of the way of this issue to get to 5% GDP. And the demand seems to be holding up, surprisingly in Europe and also in the States. So, again, a little more optimistic than I think everyone out there is less optimistic.
Tassos, Cal, John, and Ted, thank you very much. Nicholas, thank you very much for having us, inviting me. Appreciate it. Thank you.
Thank you again. Thanks.
Thanks.